Hello friends, welcome to the 10-minute miracle series. This is quick revision session of unit number 43. In the next 10 minutes you will be able to revise all the important points related to unit number 43, which is based on pension system and its aspect. So gear up for next 10 minutes and I will provide you enough content in the shortest form possible so as to revise the entire content in just 10 minutes. So let's begin with. A pension is like a safety net for your old age, giving you a monthly income when you are no longer working, right? Obviously this is called pension, right? Why is it important? As we get older, our income usually decreases, right? So monthly income during unproductive year, that is called. So why it became important? Reason we are talking about. The first reason is as we get older, our income usually decrease, and with the rise of nuclear family, migration, and the cost of living, having a pension help us live with dignity and manage unforeseen expense. Now let's talk about the pension plan. So there are two main stages to pension plan. The first is called accumulation. This is when you regularly contribute money till retirement, and the second is called vesting. After retirement you start receiving your pension payment. Now pension fund do three key things. What are the three key things done by the pension? First, collect contribution, pay out benefit on time, and third is invest the fund to grow them. Now let's talk about the financial governance and EPF. Let's talk about it in the next slide. Financial governance and EPF. So every aspect we will cover. Good financial governance is about ensuring that money is handled transparently and responsibly. For the employee provident fund, for this employee provident fund in India, it is mandatory pension system for private sector worker. If a company has 20 or more employee, they must offer this pension plan unless they have an equivalent alternative. Now, in short, pension plan help us manage our lifestyle in the old age, and EPF is one of the system ensuring that employee in India have secure future. Now, let's talk in detail about this EPFO. So, EPFO, how it works, and the contribution you and your employer make toward your future. Now, the first EPFO stands for Employee Provident Fund Organization. Sorry friends, it manages the provident fund for employee in India. As we all know, it is run by the Central Board of Trustee. Who run it? It is run by the Central Board of Trustee. So you can see written here Central Board of Trustee. Just wait a minute. Okay. So it is run by the Central Board of Trustee, as you can see, and Central Board of Trustee, which includes the government, the employee and the employer, right? So three main components: government, employer and employee. Now there are three main schemes under the EPFO. The first is called EPS, which is called Employee Pension Scheme. The second is called EDLIS, that is Employee Deposit Link Insurance Scheme, and the third is called EPF, that is Employee Provident Fund Scheme. Remember it. So EPFO job is to enforce the law, maintain account. You can see the function: enforce law, maintain account, settle claim, invest fund, ensuring pensioner payment and update record. Now UAN. So one important feature is the UN or universal account number. It links all your EPF account, making it easy to track your fund even if you switch job. Now if we talk about the contribution and benefits, so both the employee and employer contribute 12% of your salary, which includes basic plus DA, to the EPF, right? And if we talk about the employer contribution, how it is divided, let's see in the next slide how the employer contribution gets divided. So you can see 3.6% to the EPF and 8.33% to the EPS. Means it goes to EPS and it goes to EPS, that is pension scheme. Already I have told you it has three parts: EPS, EPF, EDLIS, right? Three main scheme. So EPS means employee pension scheme, EPF means employee provident fund scheme, right? So what is the benefit of this EPF? So it offers high interest rate, tax exemption, low risk and life insurance. Provide life insurance under the EDLI scheme. Already I have told you there are three parts of this EPFO. Under the EDLI scheme it provides you the life insurance, and 3.67 goes to EPF, 8.33% goes to EPS. Remember this thing, question are asked. Let's look at how this works depending on your salary. So if your salary is less than 15,000, both you and your employer contribute based on your salary. If your salary is 15,000, you contribute rupees 1800, and employ obviously 12% of 15,000 is 1800, and employer also contribute based on rupees 15,000. And if your salary exceed 15,000, you still contribute 12%. Employer contribute on minimum or current salary, right? So in summary, EPFO ensure a secure future for employee through pension, life insurance, and provident fund saving. So that is why the three components are there: pension, EPS, life insurance, EDLI, and EPF already we know. So that's all for this. Now let's discuss the exempted funds. It's very important. So I will break it down in the simplest way possible. Exempted fund, are the alternatives to EPFO plan, but still follow the same rule. They offer the same contribution rate, return, and retirement age between 58 to 60, as you can see, right? The best part is that you get tax benefit, right? This is the best part. You get tax benefit, and your contribution are deductible, and the income from the investment is tax free. So whatever investment income, it is tax exempted. These funds are managed by independent trust with employer and employee trustee involved in the decision making. As for investment, most money goes toward government or public sector bonds, but since 1998, 10% can be invested in private bonds. Remember it. Now if we talk about PPF, that is public provident fund, so it is a government backed scheme with 15-year lock-in period, and though you can extendable by 5 years, you get amazing tax benefit. Contribution are deductible under section 80C, and the returns are tax exempted. Okay, and the minimum investment is 500, maximum investment is 1.5 lakh per year. Remember it. Now some key points about PPF, let me show you. So eligibility: only Indian citizen can open PPF account. Loans are available between 3rd and 5th year of your PPF account. Retirement benefit: interest is compounded annually, and meaning you will see your money grow steadily. Now let's move on to the insurance annuity scheme. See, annuity, annuity is the reverse of life insurance. Instead of receiving a lump sum, you get regular payment after retirement or after you pass away for your hires. That is called annuity. That is the reverse of your life insurance. There are two types of annuity. The one is called immediate annuity. So payment start right away. You pay a single premium, and if something happens to you, your hires will receive the remaining payment, right? That is called immediate annuity. And deferred annuity: payment start at a future date, giving you income later in the life. So whether you are looking for long term saving with PPF or guaranteed income through annuity, both options offer excellent benefits. Now let's talk about the national pension scheme. NPS is a social security scheme by the government. This is a social security scheme. This is open to the public, private, and unorganized sector except armed force, right? Anyone who is Indian citizen can join voluntarily, right? Now the best part is that it is portable. It means that you can carry it across job and location. NPS also offer tax benefit under ATC and ATCCD, and it is managed by PFRDA and PRAN. Once you sign up, you get a PRAN, that is permanent retirement account number. And what is PFRDA? This is nothing but pension fund regulatory and development authority. Now if we talk about the types of NPS account, see, there are two types of NPS account. The first is tier 1. Tier 1 means what? A pension account with restricted withdrawal. Tier 2 means what? A voluntary account, whether you can withdraw flexibly, but only if you have an active tier 1 account. Now if we talk about the contribution, here how contribution work: employee contribute 10% of their salary, and the government matches this with another 10%, and this money is then invested and grow based on market return until you retire. Now if we talk about the corporate NPS and all citizen model, see, for company there is a corporate NPS. For companies there is a separate form of NPS, that is called corporate NPS, where business can adopt NPS with a flexible contribution rate for their employee. For everyone else, there is an all citizen model NPS work. So this NPS is defined as a let me give you an example. So how does this NPS work? Let me just wait a minute. So NPS is a defined contribution plan, right? Meaning your wealth depend on your contribution, investment growth, contribution plus investment growth, and minimal charges. So bank, public and private, acts as a point of presence, that is called POP. That bank and public bank, either it is public or it is private bank, act like a point of presence to collect your NPS payment. Now and the NSDL, NSDL is called CRA means Central Record Keeping Agency, issuing you 12-digit PRAN number. Now what is the formula for accumulated wealth? Your accumulated wealth is equal to contribution plus investment growth minus charges. Now, so NPS is the flexible, tax saving and portable way to secure your future. Now let's discuss the key components of this particular NPS. So subscriber, employer payment, right? So either you call it subscriber or employer payment, or investment growth, market dependent return, charges, admin, fund management, transaction fee, etc. Now if you talk about the accumulated pension wealth and NPS account, so first, what is accumulated pension wealth? It is total amount in your NPS account that decide your pension benefit when you retire. So there are two types of NPS account. Tier 1, we know this is a mandatory retirement account, you can't withdraw from it until you retire, and Tier 2 is voluntary and you can withdraw from it anytime. Your contribution are handled by PFM. PFM is pension fund manager, right? So which is registered with PFRDA. Now they follow a strict guideline to protect your money, investing in things like government security, corporate bonds and equities. Now you have two investment approach. The first is called active choice. So you choose the fund, right? So you can see the investment approach are two. Active choice means you choose the fund that is active, and auto choice means the system chooses for you based on life cycle strategy. Here is how withdrawal work. So partial withdrawal. So you can withdraw up to 25% of your contribution after 5 years for a specific reason, right? Premature withdrawal after 10 year or after 10 year or after 3 year if you join post 60, and normal withdrawal after 60 year or 3 year after joining if you join post 60. So when you retire, you can withdraw 60% of your corpus, right? And remaining 40% must go toward purchasing an annuity for regular income, right? Now if we talk about the extended contribution, you can continue contributing until you are 75 years old and exit anytime before then if you want. So that is a quick overview of how your NPS account work, from growing your pension wealth to managing withdrawal. Now let's talk about the Tier 2 account. Already I have told you several times that Tier 2 account is super flexible. You can make unrestricted withdrawal anytime, unlike the Tier 1 account. But keep in mind, when you close your Tier 1 account, the Tier 2 account get closed too. Now let's talk about ASP. ASP means annuity service provider. So these are organizations licensed by IRDA, and currently there are 7 impaneled ASP offering annuity which give you a regular income after retirement. Now let's move on to the Atal Pension Yojana. Atal Pension Yojana designed to give pension benefit to worker in unorganized health worker. So you can see in this PDF I have highlighted all the important points, and if you want this PDF you can enroll in our Ie&Ifs capsule course. The link of the course is provided in the description section, and I will provide you similar PDF for all the units. This will help you in quick revision of entire units. So eligibility is that you must be guaranteed pension to 1000 to 5000 per month. This is the guaranteed pension, and eligibility is that you must be 18 to 40 years, this range, right? Citizenship must be an Indian citizen including NRI. However, if you have income tax liability from 1st October 2022, so you are not eligible. Now account requirement, you will need a saving bank account or post office saving account to join. If you don't have one, you can open it through a bank or post office. If you talk about the employment status, it is open to all citizens, no matter whether you work whether in government, public sector or private. Now that's a quick overview of Tier 2 everything. So this was all about our chapter. Hopefully you enjoy the session. If you really think this video was useful, please hit the like button, do subscribe our channel for receiving such type of content, and do share with your fellow colleague. And for PDF you can WhatsApp me on this particular number, or you can enroll in our Ie&Ifs capsule course program. Thank you.